Hello, folks. Brandon Chapman today. It's another edition of a TheoTrade video for February 10th, 2025. The topic is a new paradigm in gold and materials stocks. It's been one of those situations over the last 20 plus years, really going back to the 80s. We've really pursued a weak dollar policy. We've saw policy to try to ship our manufacturing abroad, largely to Asia. We've subsidized it. We've done everything we can to say, hey, let's produce a lot of cheap products in Asia. We'll import them. We'll maintain this negative trade balance. We'll subsidize it. We'll do all this other stuff, protect it, nourish it, and everything. And somehow that the debt that subsequently comes forth, that it's going to be good for us. And as long as we maintain those massive trade deficits, we have a buyer for our debt. We have low interest rates. But folks, we've come to an end of that paradigm. We've come to a ignominious end as deficits and debt spiraled. We're seeing inflation. We're no longer able to export it like we have in the past. And we're in a very sticky situation at the moment that is impacting markets, impacting the bond market. If we look at /ZB, the treasury bond market here, we'll go back, 10-year weekly, huge selling in 2020, followed that massive stimulative efforts by the Fed, printing $5 trillion, or expanding their balance sheet by $5 trillion. And then the carry-on effect is that those funds are leveraged in the age of Doge, in the age of Trump tariffs and other factors. How is this shifting and making changes to the market potentially permanently away from a debt-based economy more towards savings and investment and production in the United States? And how do we walk that tightrope? Well, one of the areas that we're seeing probably one of the most impact due to Trump tariffs is gold and silver. We'll just use GLD and SLV as a proxy. If we look at it, since about mid-January, we broke out from the symmetrical triangle, and it's basically been up and away. We've had a few 4 or 5 down days since January 14th. And if we look at over here in the last 12 weeks, today, the second best performing, outperforming every other sector except for another commodity space, which is energy. But in 12 weeks, notice what happened here. Gold has outperformed every other sector in the market, and the S&P's only mustered a 1% gain in the last 12 weeks. Gold substantially outperforming. Historically, this has never been great for the S&P 500 when gold is leading. Why is that, by the way? Well, gold over time is a negative yielding asset in real terms. You got to pay to store it. I guess you could lease it out and try to generate some return. That's kind of where we're standing right now. If you've read any kind of the news Thursday, Friday of last week, the borrowing cost to borrow GLD shares or SLV shares went through the roof. We're getting notes from the London Bullion Bank that they're running out of gold. They're trying to get it from the Bank of England. They're telling you, hey, you got about 6 weeks maybe to get your gold if you want it. And as a result, we're seeing a little bit of panic buying in gold and silver. What's creating this dynamic? Well, one of the biggest things right now is the fact that they're short on gold. Receipts for gold in the Bank of England are trading at a discount to gold here in the United States. What does that mean? It basically allows people to try to secure gold in London and put it on an airplane and ship it to the United States. Okay, that difference in rate for gold is basically helping funnel more and more gold back to the United States, to the COMEX, where they've increased their gold supplies about 50% since the beginning of the year. We're seeing this rush to get gold and silver back into the United States. And you see what's happening in the gold market, especially. Even the copper market's participating in this. We need to deliver gold. We need to deliver silver. We need to deliver copper. Well, why is this going on? Because again, tariffs. If all of a sudden we're going to tariff Mexican gold at 25% or Canadian gold at 25%, the third largest importer to the United States is Colombia. Oh, wait, have we had discussions with all three of those and South Africa, by the way? Yeah, all these gold and commodity producing countries are squarely in the sights of tariffs. What they found that gold was not one of the things that were exempted by the tariffs. Now, all of a sudden, if gold prices are trading at, for example, at $29.33, we add 25% to that. And all of a sudden, what happens? We're trying to get gold as fast as we can back in the United States to deliver it. People are wanting delivery. There's some big trades kind of sitting out there in the futures market, wanting to likely to accept delivery. And we have all this stuff coming together in the short run that's driving gold prices higher. Is this a structural shift, though? Again, short run dynamics regarding tariffs certainly isn't a paradigm shift. But a new paradigm's created if suddenly we have the desire to want to revalue gold. Well, currently on our balance sheet in terms of the treasury, it's at $42 an ounce, a price that's been around for a long time, right? Bretton Woods, all this other stuff going on, right? We went off the gold standard. We have not repriced gold in terms of on the balance sheet of the U.S. government. Here we have Treasury Secretary Bressent talking about we're going to start to leverage the asset side of the balance sheet. We've had previous, like Judy Shelton, talk about, hey, we want to issue gold-backed debt, maybe 50 years, what, $5 trillion. Where is gold going to go in that particular thought process? 3,000? We're pushing that right now. If you think about all of the assets with which gold can buy, gold is maybe a tenth of where it should be. And what does that mean? If we revalue gold in terms of allowing it to be priced in the idea we could purchase all of these assets denominated in dollars, gold could be repriced significantly higher in the long term. And as we turn our attention to gold stocks are trading at one of the lowest valuations right now and have among the highest cash flow of any industry in the equity markets. In fact, precious metals has the highest cash flow of any sector over on the left-hand side over here. So as we think about companies that produce gold or have gold royalties, all of these possibilities kind of shaking out here. Silver producers. Well, if we look at the gold and silver ratio, well, right now, silver's trading at a huge discount. If we start to see the dollar diminish in value as we shift towards more of a hard asset kind of global economy, silver might be tremendously undervalued in this respect. And historically, silver's caught up as interest rates have fallen, as the Fed provided additional liquidity. What's happening right now, news coming out of the administration in terms of cutting cost, Doge and the like, basically saying, look, we're not going to support the world economy. We're not going to be the policeman of the world. It's bankrupting us, right? And so as a function, we're seeing a shift. Canada, we're no longer going to pay your freight to defend your country as part of NATO or even locally, domestically. But if you want to be our 51st state, boy, we'll welcome you in here. Again, Trump's continuing to kind of echo that. We've had these tariff kind of threats because why? We've helped supply money to the world and all these foreign countries, and that is coming to an end potentially. Okay, I say potentially because it hasn't happened yet, right? We're having a lot of resistance of wanting to say, look, we want the U.S. to operate more independently. We want to be able to operate more efficiently with less debt and change this kind of the structure of our economy. And a lot of traction doing it, cutting costs and the like, is certainly reordering things. So tariffs, yes, in the near term is shifting towards gold. But in the bigger picture, gold may have to be revalued. If we were to issue, for example, debt denominated with the backed by gold, we would need to revalue gold at a much higher price, right? So that gold ultimately is reflecting its real value in society, which right now gold at 3,000 probably is not representing that, or the stuff that it can buy in terms of all these paper assets, paper, gold, etc., ultimately is not worth the value that they're printed on. Circling back to the Bank of England, for example, all of a sudden their receipts for deposits held there are trading at a discount to gold that you're securing in the United States. They don't believe, again, the delay, there's questions, right? That again, is there more claims to every ounce of gold held in London than are actual gold available? Fractional reserve banking right now is struggling, and we're seeing the signs right now in the gold market. So regardless of whether we think this is a short-term phenomenon or a bigger paradigm shift right now, we're seeing the pressures on, we're seeing higher gold prices, we're seeing higher silver prices, we're seeing higher copper prices also in that context. if we have a scan here looking at option activity, I call them option pulses, and you can see this is in the materials, metal, and mining space. We got Cleveland Cliffs, Cenex, CMC. It's not just gold, right? If we look at CLF today, right, we're talking about what? Iron ore breaking out up 17.5%. I just sent a message to our members back here on January 6th. We talked about putting on an out of the money call spread, looking at a breakout in iron ore, specifically CLF. And that spread I sent out and a message in our chat room to close it out for over 130% gain over that period of time, with buying the 10 call, selling the 12. Again, we had skew that was in our favor and other factors. One of the more undervalued stocks, NUE, over the last few weeks, we've been talking about this as far as an opportunity in the metal space. Recently, I kind of talked about ERO with the move in silver. This is a Canadian company. If you look at the analyst tab up here, but fundamentals, it is a Canadian company. Where do they manufacture, produce copper? It's in Brazil. So again, maybe subject to, maybe not in the short run. They're not in Mexico. They're not in Canada. So again, we're kind of looking outside of that. I'm looking for a big move in ERO copper. We had a very similar dynamic occur in 2020. We're seeing that kind of stuff set up right now in the market. And if we go back to 2020, this was one of my picks because of the dynamics and the shortages that were happening. ERO made a move from about $6 up to about 24 over about a 1 year period. Are we looking at that possibility now with ERO? Maybe. We might have a chance of getting back to 23 or 24. So as we consider individual equities, I was looking at on Friday, shared with our members particular stocks like AUST. Again, this is a exploration company. They don't have any revenue. They don't have any debt, really. Lots of cash right now. And if they strike gold in Nevada, could really take off. Some of the members, executives in this company were kind of originally with SSRM when it was an exploration company. And UUU, for example, so an experienced group, again, thinking they may have found it. They're doing some testing and stuff like that. What possibly is there? DC had some good news, right? Again, an exploration company, no revenues, inching closer to potentially manufacturing. So again, we've had a number of kind of different plays I've talked about with our members at TheoTrade. And again, we're going to continue a theme. We may have a little bit of a couple-day focus on some of these dynamics and sharing some of the information I've kind of laid out here in a very quick fashion. But just realize is that there is ways to trade. If you're trading GLD, SLV is one way to go. Certainly the market itself is amenable to trading upside call spreads. Because why? We have positive skew, right? There's an element to these issues where there is maybe some short interest here, hedging with calls. And if you're bullish on gold, you can buy the lower strike and sell the higher strike. Those prices are very cheap because the volatility is rising as you move out of the money, as they're buying calls to hedge some of the shorts that are in GLD and SLV as well. Again, creating opportunities for those that are spread traders to capitalize on this market by buying the lower strike and selling the higher strike. Again, buying low vol, selling high vol, making these spreads very cheap. And again, there's ways to trade, and those are some things that we go over every day at TheoTrade. I do my sessions, and so my focus over the last number of weeks has been gold. We've certainly in gold and silver stocks, gold itself, because of seasonal factors and other things. And so the idea is that there is a paradigm shift that's likely happening right now, that if the policies are able to continue, could be big for the gold market. Anyway, folks, that's what I've got for today. I will catch you back on next week's video. Thanks. Have a great one.